Most people think they know the story of the Wall Street crash of 1929, a generation of Americans drunk on easy money, buying stocks with borrowed cash, ignoring every warning sign. And then, one cold October morning, the whole thing collapses. Bankers leap from windows. Fortunes evaporate overnight. The Great Depression begins. It's a clean, dramatic narrative, and it's repeated in every history textbook, every documentary, and every cautionary tale about financial excess. But here's the problem. Almost every part of that story is either incomplete, exaggerated, or flat out wrong. Now, I'm not saying the crash didn't happen. It did, and it was devastating. But the version most of us have been taught, the one where a single week in October destroys the American economy, where suicidal bankers rain from the sky, where one event triggers a decade of suffering, that version is a myth built on half-truths, convenient simplifications, and in some cases, outright fabrications. And the real story, the one historians and economists have been arguing about for nearly a century, is far more interesting, far more complex, and far more relevant to the world we live in today. So let's rewind the clock and start where we need to start. Not on Black Thursday or Black Tuesday, but years earlier, in the strange, intoxicating decade that made the crash possible. Because the 1920s weren't what most people think they were either. When we talk about the Roaring Twenties, the images that come to mind are jazz clubs, flappers, Model T Fords rolling off the assembly line, and ticker tape streaming across the floors of brokerage offices in lower Manhattan. And sure, those things existed. There was genuine economic growth. Industrial production surged. New technologies like radio, refrigeration, and the automobile transformed daily life. Consumer spending climbed. It looked like America had cracked the code on permanent prosperity. President Calvin Coolidge famously said that the business of America is business, and for a few glorious years it seemed like he was right. But here's what the textbooks usually gloss over. The Roaring Twenties were not roaring for everyone, not even close. The prosperity of that decade was shockingly concentrated among a tiny sliver of the population. By 1929, the top 1% of American families received nearly 24% of all pre-tax income. Think about that. A single percent of the population was pulling in almost a quarter of the nation's earnings. Meanwhile, roughly 80% of American families had virtually no savings at all. Zero. Nothing. They were living paycheck to paycheck in a supposedly booming economy. Wages for factory workers, miners, and farmers had barely budged throughout the decade, even as corporate profits climbed by over 60%. The productivity gains of the 20s, all those new machines and assembly lines that made everything faster and cheaper, those gains flowed overwhelmingly to the owners and shareholders, not to the workers on the factory floor. American industry was producing more goods than ever before, but the vast majority of Americans couldn't afford to buy them. This is what economists call the problem of underconsumption, and it was quietly eating away at the foundations of the economy long before the stock market showed any signs of trouble. And then there was agriculture. If you lived in a city in the 1920s, you might have believed that America was enjoying an age of limitless wealth. But if you lived on a farm, you knew better. The agricultural sector had been in a slow-motion crisis since the end of World War I. During the war, American farmers had expanded aggressively to feed Europe. They bought more land, more equipment, took out bigger loans. But once the war ended and European agriculture recovered, demand for American crops plummeted, prices collapsed. Farmers who had borrowed heavily to expand suddenly found themselves unable to service their debts. Throughout the 20s, thousands of small rural banks failed, one after another, quietly and without fanfare. Most city dwellers never even noticed. So the image of the 1920s as a golden age of universal prosperity is the first big myth. The reality was far more uneven, a thin layer of wealth at the top, a struggling agricultural base at the bottom, and a growing mountain of consumer and margin debt holding the whole thing together in between. That's the foundation the stock market boom was built on. Now, let's talk about the boom itself, because this is where the story starts to get really interesting. Between 1921 and 1929, the Dow Jones Industrial Average went from 63 points to 381 points. That's a six-fold increase in just 8 years. Stocks weren't just rising, they were rocketing upward at a pace that had never been seen before in American history. And the mechanism that made it possible was something called margin buying. Here's how it worked. An ordinary person could walk into a brokerage office and buy $1,000 worth of stock by putting down as little as $100 of their own money, sometimes even less. The broker would lend them the rest, using the stock itself as collateral. As long as the stock kept going up, everyone was happy. The investor made massive returns on a tiny initial investment. The broker collected interest on the loan plus commissions, and the banks that funded the brokers earned steady returns on what appeared to be perfectly safe lending. By the summer of 1929, broker loans, the money lent to investors to buy stocks on margin, had reached approximately $8.5 billion. To put that in perspective, that was more than the entire money supply of the United States at the time. The whole system was essentially a giant pyramid of borrowed money, and it could only survive if stock prices kept climbing. The moment prices stopped rising, the whole structure would begin to unravel, because brokers would start issuing margin calls, demanding that investors put up more cash. If those investors couldn't pay, their stocks would be sold at whatever price the market would bear, which would push prices down further, triggering more margin calls, which would force more sales, and so on in a vicious downward spiral. Now here's the thing that most textbook accounts get wrong. The people at the top of the financial system, the bankers, the Federal Reserve governors, many of the largest investors, they knew this was dangerous. This wasn't some hidden risk that nobody saw coming. The Federal Reserve had been warning about excessive speculation as early as 1928. In fact, between January and July of 1928, the Fed raised the discount rate from 3.5% to 5%. Because nominal prices were actually falling at the time, the effective real interest rate was closer to 6%, which is extremely high for a year that followed a mild recession. The Fed also sold off more than 3/4 of its total stock of government securities in an effort to drain reserves from the banking system and cool off the speculation. But here's where we encounter one of the most important and least understood aspects of the crash. The Fed's attempt to rein in Wall Street speculation didn't just affect speculators, it affected the entire economy. Higher interest rates made it more expensive for ordinary businesses to borrow money. They slowed down construction, manufacturing, and consumer spending. The economy was already weakening by the spring and summer of 1929, months before the crash. Industrial production had peaked in June. Auto sales were falling. Construction was declining. The economy was slipping into recession before a single share was panic sold on the floor of the New York Stock Exchange. This is a crucial point that most popular accounts completely miss. The crash didn't cause the economic slowdown. The economic slowdown was already underway. The crash amplified it, accelerated it, and turned a manageable downturn into a catastrophe. But the seeds of the disaster were planted long before Black Thursday. And speaking of Black Thursday, let's talk about what actually happened during those infamous October days. Because even the basic timeline is more complicated than most people realize. The market had actually started to wobble in September. After hitting its all-time high of 381 points on September 3rd, 1929, the Dow began to drift downward. There were small sell-offs, brief recoveries, the kind of choppy trading that made people nervous but didn't trigger outright panic. Then, on October 23rd, the market dropped 4.6% in a single session. It was a sharp decline, but not unprecedented. The real trouble began the next day. On Thursday, October 24th, the day that would become known as Black Thursday, the market opened to a wave of selling. Prices fell rapidly. The ticker tape, the only technology available to track stock prices in real time, couldn't keep up with the volume of trades. It fell further and further behind, which meant that investors across the country had no idea what their stocks were actually worth. They were making decisions based on prices that were already minutes or even hours out of date. Panic spread not because of what people could see, but because of what they couldn't see. By noon, the situation was critical. Nearly 13 million shares had been traded, smashing the previous single-day record by almost 4 million. The floor of the New York Stock Exchange was chaos. Runners were sprinting between brokers. Phone lines were jammed. Outside on Wall Street, a crowd of thousands gathered, staring up at the buildings, feeding on rumors and fear. And then something remarkable happened. A group of the most powerful bankers in the country, led by Thomas Lou Mont of J.P. Morgan and Company, gathered at the Morgan offices at 23 Wall Street, directly across from the stock exchange. They pooled together roughly $240 million and began buying blocks of stock at above-market prices. The idea was to demonstrate confidence, to signal to the market that the big players still believed in the system. It was the same strategy that J.P. Morgan himself had used during the panic of 1907, and for a few hours it seemed to work. The market stabilized. The Dow actually closed down only about 6 points from the previous day's close. Headlines the next morning were cautiously optimistic. The worst, many believed, was over. But it wasn't over. It wasn't even close to over. The weekend gave investors time to think, and what they thought about was fear. They thought about those terrifying hours on Thursday when nobody knew what anything was worth. They thought about the margin calls that had already gone out. They thought about the money they owed. And when the market reopened on Monday, October 28th, the selling resumed with a ferocity that the bankers' coalition couldn't contain. The Dow fell nearly 13% in a single day. No amount of confidence signaling could stop it. And then came Black Tuesday, October 29th, 1929, the day that lives in infamy. More than 16 million shares were traded on the New York Stock Exchange, a record that would stand for decades. The ticker tape ran nearly 3 hours behind. People were selling at any price they could get, often at losses they couldn't even calculate, because nobody knew what the current prices actually were. When the dust settled, the Dow had fallen another 12%. In just 2 days, the market had lost roughly a quarter of its value. Now, here's where the conventional story really starts to fall apart, because what happened next is something that most people don't know and that many historians conveniently ignore. After the crash of late October, the market actually recovered. Not fully, not to its pre-crash highs, but substantially. By April of 1930, the Dow had climbed back to nearly the same level it had been at before Black Thursday. Historian Richard Sill, has pointed out that people tend to ignore this recovery because it's inconvenient for the narrative. If the crash really did cause the Great Depression, then the recovery shouldn't have happened. But it did. So if the crash didn't directly cause the Great Depression, what did? This is the question that economists and historians have been wrestling with for nearly a century. And the answer involves a series of catastrophic policy failures that unfolded over the years following the crash. Failures that turned what could have been a sharp but temporary recession into the worst economic disaster in modern history. The first and arguably most important failure was the Federal Reserve. Now, most people think of the Fed as this all-powerful institution that can steer the economy with the flick of a switch. But in 1929, the Fed was barely 16 years old. It was still figuring out what it was supposed to do and how it was supposed to do it. And in the years following the crash, the Fed made a series of mistakes that economists now regard as some of the worst policy decisions in the history of central banking. The most damaging of these was the Fed's decision to let the money supply contract. Between 1929 and 1933, the money supply in the United States fell by roughly one-third. One-third. That means that for every $3 circulating in the economy before the crash, only 2 remained by the depths of the Depression. This wasn't inevitable. This was a policy choice, or rather a failure to act. The Fed had the tools to inject money into the banking system, to provide liquidity to banks that were struggling, to prevent the cascade of bank failures that was about to unfold. But it didn't use them. Why not? This is where the gold standard enters the picture, and this is one of the most underappreciated factors in the entire story. In 1929, the United States and most major economies operated under the gold standard, which meant that the value of the dollar was fixed to a specific quantity of gold, $20.67 per ounce. The Fed was legally required to maintain this parity, which meant that every dollar in circulation had to be backed by a certain amount of gold in the vaults. This created a devastating constraint. If the Fed wanted to expand the money supply to help the struggling economy, it risked depleting its gold reserves, which could force the country off the gold standard entirely, something that was considered unthinkable at the time. So the Fed chose to protect the dollar's gold backing rather than protect the economy. It chose sound money over human welfare, and the results were catastrophic. In the autumn of 1930, more than a year after the crash, the first major wave of bank failures began. The Bank of the United States, despite its official sounding name, actually a private commercial bank, collapsed in December of 1930, wiping out the savings of roughly 400,000 depositors. It was the largest bank failure in American history up to that point, and it sent shockwaves through the financial system. More importantly, it triggered a crisis of confidence. Ordinary Americans, who had been keeping their money in banks, suddenly realized that their deposits were not safe. There was no federal deposit insurance at the time. If your bank went under, your money was simply gone. What followed was a slow-motion catastrophe. Bank runs spread across the country. Panicked depositors lined up outside their banks, demanding to withdraw their savings before it was too late. But banks, by their very nature, don't keep all their depositors' money in the vault. They lend most of it out. So when everyone showed up at once demanding their cash, the banks couldn't pay. More banks failed. More depositors lost everything. And as the banks collapsed, so did the credit system that the entire economy depended on. Businesses couldn't get loans to operate. Farmers couldn't get credit to plant crops. And the economic bloodletting accelerated. Between 1929 and 1933, more than 5,000 American banks failed. 5,000. And the Fed, the institution that was supposed to be the lender of last resort, the backstop against exactly this kind of cascading failure, largely sat on its hands. In 2002, Ben Bernanke, who was then a governor of the Federal Reserve and would later become its chairman, gave a speech at a conference honoring the 90th birthday of economist Milton Friedman. In that speech, Bernanke made a remarkable admission. Speaking directly to Friedman, who along with his co-author Anna Schwartz had spent decades arguing that the Fed's mistakes caused the Great Depression, Bernanke said, and I want to paraphrase carefully here, that Friedman was right, that the Fed bore significant responsibility, and that it would not make the same mistakes again. That acknowledgement was extraordinary. The chairman of the Federal Reserve publicly admitting that his own institution had caused the worst economic disaster in American history. You don't hear about that in most textbook accounts of the crash. Now, let's talk about another factor that most popular histories get wrong, and that's the role of the Smoot-Hawley tariff. In June of 1930, President Herbert Hoover signed into law the Tariff Act of 1930, commonly known as the Smoot-Hawley Tariff, named after its sponsors, Senator Reed Smoot of Utah and Representative Willis Hawley of Oregon. The act raised tariffs on more than 20,000 imported goods, with average rates climbing to roughly 60% on some products. The idea was to protect American industries and farmers from foreign competition during the economic downturn. On paper, it sounded reasonable. In practice, it was a disaster. Other countries immediately retaliated. Canada, America's largest trading partner, imposed counter tariffs on American goods and lowered tariffs on imports from the rest of the British Empire. France, Germany, Italy, and dozens of other nations followed suit. By 1932, world trade had plummeted by roughly 66% from its 1929 levels. The global trading system essentially collapsed. Now, here's where the historical debate gets nuanced. Some economists, particularly in the monetarist tradition, argue that Smoot-Hawley's direct impact on the economy was relatively small because foreign trade only accounted for a modest share of American GDP at the time. They argue that the real villain was the Federal Reserve's monetary contraction and that Smoot-Hawley was more of a sideshow than a main event. But other economists, particularly those who study the international dimensions of the Depression, point out that Smoot-Hawley's effects went far beyond the simple arithmetic of trade volumes. The tariff caused agricultural export markets to collapse, which devastated farm incomes, which in turn caused a wave of rural bank failures that rippled through the entire financial system. The money supply contracted by 29% between 1929 and 1933, and a significant portion of those bank failures can be traced directly or indirectly to the agricultural crisis that Smoot-Hawley intensified. So the relationship between the tariff and the Depression is not the simple cause and effect story that either side wants to tell. It's more like a web of interconnected failures, each one amplifying the others. The tariff didn't cause the Depression by itself, but it made it significantly worse, and it turned what might have been a primarily American crisis into a truly global catastrophe. And this brings us to one of the most persistent and pervasive myths about the crash, the one about bankers jumping out of windows. You've heard this one. It's practically baked into our cultural memory. The image of distraught financiers leaping from skyscraper ledges has been referenced in movies, novels, songs, and casual conversation for nearly a century. There's just one problem. It never happened. At least, not in the way the myth suggests. John Kenneth Galbraith, the economist who wrote what is probably the most famous book about the crash, examined U.S. death statistics for October and November of 1929 and found that the number of suicides during those months was actually among the lowest of any month that year. The suicide rate had been substantially higher during the summer months before the crash even happened. New York City's chief medical examiner at the time, a man named Charles Norris, felt compelled to publicly refute the rumor in mid-November of 1929, stating that while 44 suicides had occurred over the previous 4 weeks in Manhattan, that number was actually lower than the 53 recorded over the same period the year before. Between Black Thursday and the end of 1929, only 4 of the roughly 100 suicides and suicide attempts reported in the New York Times were falls linked to the crash, and only 2 of those took place anywhere near Wall Street. One of them wasn't even an investor. It was Hull Dabu Roski, a clerk who had worked at a Wall Street brokerage house for 28 years and jumped from a 40-story building on November 5th. So where did the myth come from? It was partly fueled by the press, which was hungry for dramatic stories. London newspapers gleefully reported that pedestrians on Wall Street had to thread their way through the bodies of fallen speculators. Will Rogers, the humorist, quipped that you had to stand in line to get a window to jump out of. Even Winston Churchill, who was in New York during the crash and was himself a major stock market investor, may have contributed when he wrote in a December 1929 newspaper article about how a man had thrown himself from a building near his hotel window. The story was too good not to tell, even if it was mostly fiction. Now, I want to shift gears and talk about something that the conventional narrative almost completely ignores, and that's the question of who actually profited from the crash. Because while millions of ordinary Americans were watching their savings evaporate, a small number of very smart, very well-connected people were getting phenomenally wealthy. The most famous example is Joseph P. Kennedy, the patriarch of the Kennedy political dynasty. Kennedy had made a fortune in the stock market during the 1920s. But according to multiple accounts, he began pulling his money out of stocks well before the crash. There's a famous anecdote, possibly apocryphal but widely repeated, that Kennedy decided to sell his stocks after a shoeshine boy started giving him stock tips. The reasoning, supposedly, was that if even shoeshine boys were speculating in the market, then the market had become too crowded and a crash was inevitable. Whether or not the shoeshine boy story is true, the underlying logic is sound, and Kennedy's timing was impeccable. He not only avoided the crash, but reportedly made millions by short-selling stocks, essentially betting that prices would fall. Percy Rockefeller, a nephew of John D. Rockefeller, also reportedly made millions by shorting stocks. And there were others, less famous but equally shrewd, who saw the bubble for what it was and positioned themselves to profit from its implosion. The crash, like every financial crisis before and after it, was not a disaster for everyone. It was a massive transfer of wealth from the many to the few, from the unsophisticated to the sophisticated, from the overleveraged to the cash-rich. This raises uncomfortable questions that most historical accounts prefer to avoid. To what extent was the crash a natural outcome of market forces? And to what extent was it manufactured, or at least exacerbated by those who stood to gain from it? I want to be clear here. I'm not suggesting some grand conspiracy. Markets are complex systems, and the crash of 1929 was driven by a convergence of structural weaknesses, policy failures, and human psychology that no single group could have orchestrated. But it's also true that the people who had the most information, the most access, and the most resources were disproportionately the ones who came out ahead. That pattern repeats itself in virtually every financial crisis in history, and it's worth acknowledging. Let me take you back to an important detail that often gets buried in the broader narrative. The United States wasn't the only country suffering. The Depression was a global phenomenon, and understanding why requires understanding the international monetary system of the time, the gold standard. Under the gold standard, countries that experienced an outflow of gold, because they were running trade deficits or because investors were moving money elsewhere, were supposed to respond by tightening their monetary policies, raising interest rates, and reducing the money supply. This was supposed to be self-correcting. Higher interest rates would attract capital back into the country, gold would flow in, and balance would be restored. But in practice, during a severe downturn, this mechanism was devastating. Countries that were already struggling were forced to make their economies even weaker in order to defend their currencies. It was like treating a patient with pneumonia by bleeding them. France, which had accumulated massive gold reserves during the 20s, was particularly problematic. The French central bank was hoarding gold, sucking it out of the international system, and forcing other countries to tighten their policies in response. Britain, which had returned to the gold standard in 1925 at an overvalued exchange rate, was trapped in a deflationary spiral that it couldn't escape without abandoning gold altogether, which it finally did in September of 1931. When Britain left the gold standard, it sent shockwaves through the global financial system. Countries that had been holding their reserves in British pounds suddenly found those reserves worth less than they had expected. More bank failures followed. More countries left the gold standard. The international monetary system was disintegrating. And through all of this, the Federal Reserve, constrained by its commitment to the gold standard, continued to prioritize defending the dollar's gold parity over rescuing the domestic economy. In the autumn of 1931, when Britain's departure from gold triggered a speculative attack on the dollar, the Fed actually raised interest rates, making the Depression even worse. It was, by almost any measure, one of the most destructive policy decisions in the history of central banking. Economist Barry I. Ken Green, in his influential book on the subject, argued that the gold standard was essentially a set of golden shackles that prevented governments from responding to the crisis in the way that the situation demanded. Countries that left the gold standard earlier, like Britain in 1931 and the United States in 1933, recovered faster than those that clung to it longer. The pattern was so consistent that I. Ken Green was able to demonstrate a direct statistical correlation between the timing of a country's departure from gold and the depth and duration of its depression. The longer you stayed on gold, the worse you suffered. This insight that the gold standard was one of the primary transmission mechanisms of the Depression is one of the most important contributions of modern economic history to our understanding of what happened, and yet it barely features in most popular accounts of the crash. The average person thinks the crash happened because of greed and speculation, and while those were certainly factors, the real story is far more systemic. It's about institutional failures, policy mistakes, and the deadly rigidity of an international monetary system that tied the hands of policymakers at precisely the moment when flexible action was most desperately needed. There's another major misconception I want to address, and it has to do with Herbert Hoover. The popular image of Hoover is of a president who did nothing, who sat in the White House twiddling his thumbs while the economy collapsed around him. The very word Hooverville, the name given to the shanty towns that sprang up across America during the Depression, has become synonymous with governmental inaction. But this image is not entirely fair. Hoover actually did quite a lot in response to the crisis, far more than most presidents would have done at the time. He convened conferences of business leaders and urged them to maintain wages. He pushed for increased federal spending on public works. He signed the Emergency Relief and Construction Act, which provided federal loans for relief efforts. He even created the Reconstruction Finance Corporation in 1932 to make emergency loans to banks, railroads, and other institutions. The problem wasn't that Hoover did nothing. The problem was that what he did was grossly insufficient given the scale of the crisis, and some of his actions, like signing Smoot-Hawley and raising taxes in 1932 to balance the federal budget, actively made things worse. Hoover was a prisoner of the economic orthodoxy of his time, which held that government budgets should be balanced even during downturns, that the gold standard must be preserved at all costs, and that the economy would eventually correct itself if left alone. He was applying 19th century economic thinking to a 20th century crisis, and the results were catastrophic. It took Franklin Roosevelt's inauguration in March of 1933 and the sweeping actions of the first 100 days to begin turning things around. Roosevelt took the United States off the gold standard, launched massive public works programs, established the Federal Deposit Insurance Corporation to protect bank depositors, created the Securities and Exchange Commission to regulate the stock market, and fundamentally transformed the relationship between the federal government and the economy. Some of these reforms worked brilliantly, others were less effective. But the sheer scale and ambition of the New Deal represented a radical break from the failed policies that had allowed the Depression to deepen for more than 3 years. Now, I want to bring all of this back to the central question. What do historians get wrong about the Wall Street crash of 1929? The first and most fundamental error is the conflation of the crash with the Depression. The crash was a dramatic event, a terrifying few days in October that wiped out billions in paper wealth, but on its own, it did not cause the Great Depression. The market recovered substantially by the spring of 1930. What turned a sharp but potentially temporary recession into a decade-long economic catastrophe was a series of policy failures that unfolded over the following years. The Fed's contraction of the money supply, the wave of bank failures, the Smoot-Hawley tariff, and the constraints of the gold standard. The crash was the spark, but the kindling had been building for years, and the fire that followed was made far worse by the firefighters themselves. The second error is the myth of universal surprise. The crash was not a bolt from a clear blue sky. Warning signs had been flashing for months. Economist Roger Babson had warned publicly in September of 1929 that a crash was coming. The Fed had been raising interest rates to try to cool speculation since 1928. Business leaders knew that stock prices were disconnected from underlying economic reality. The crash was not unforeseeable. What was unforeseeable was the scale of the policy failures that followed. The third error is the suicide myth. The image of bankers jumping from windows is cultural folklore, not historical fact. The suicide rate in New York in the months following the crash was actually lower than normal. The myth was created by journalists, humorists, and storytellers who found the image too dramatically perfect to fact-check. It persists because it satisfies our desire for poetic justice, for a narrative in which the greedy are punished by their own despair, but reality is rarely that neat. The fourth error is the myth of democratic speculation. We're often told that everyone was in the market, from shoeshine boys to housewives to taxi drivers. And while it's true that stock market participation expanded significantly during the 20s, the actual numbers tell a different story. Only about 2.5 to 3% of the American population owned stocks in 1929. The vast majority of Americans had no direct exposure to the stock market whatsoever. The crash devastated a relatively small class of investors and speculators. What destroyed the broader economy was not the loss of stock market wealth per se, but the cascade of bank failures, credit contractions, and policy mistakes that followed. The fifth error, and perhaps the most important one, is the failure to recognize that the crash and the Depression were symptoms of deeper structural problems in the American and global economies. The extreme concentration of wealth, the stagnation of wages, the weakness of the agricultural sector, the fragility of the banking system, the rigidity of the gold standard, these were the real causes of the catastrophe. The crash was merely the event that exposed them. Fix the stock market and you still have all those underlying problems. Which is exactly why the market recovered in the spring of 1930, and the economy continued to deteriorate anyway. There's a final dimension to this story that I think deserves more attention than it usually gets, and that's the question of what the crash tells us about the present. Because the parallels between the 1920s and our own era are more striking than most people realize. Rising wealth inequality, stagnating wages for the majority of workers, an economy increasingly dependent on debt and financial speculation, asset prices that seem disconnected from underlying economic fundamentals, a political system captured by the interests of the wealthy, and a sense that the good times will last forever. These aren't just features of the 1920s, they're features of our own time. And the lesson of the crash is not the simplistic moral that greed is bad and speculation is dangerous, although those things are certainly true. The deeper lesson is about the fragility of complex financial systems, the danger of rigid ideological commitments, whether to the gold standard or to balanced budgets or to market fundamentalism, and the catastrophic consequences of policy failures at moments of crisis. The crash itself was survivable. What followed didn't have to happen the way it did. It happened because the institutions and individuals who were supposed to protect the economy instead made it worse, sometimes through negligence, sometimes through ideological blindness, and sometimes through the simple human tendency to apply yesterday's solutions to today's problems. Milton Friedman and Anna Schwartz demonstrated decades ago that the Federal Reserve's contraction of the money supply was a primary cause of the Depression. Barry I. Ken Green showed that the gold standard transmitted the crisis from country to country and prevented governments from responding effectively. Peter Tem highlighted the role of fiscal policy in the collapse of consumer demand. Christina Romer argued that the crash's primary impact was psychological, destroying consumer and business confidence at a moment when the economy was already weakening. Each of these scholars has illuminated a different piece of the puzzle, and together their work paints a picture that is far more complex, far more nuanced, and far more useful than the simple story we all learned in school. The crash of 1929 wasn't just a story about the stock market. It was a story about the failure of institutions, the limits of ideology, the consequences of inequality, and the terrifying speed with which a wealthy, confident society can descend into chaos when the systems it depends on stop working. And the most dangerous thing about this story is not the crash itself. It's the fact that we keep telling ourselves the wrong version of it, the version where it was all about speculation and greed, the version where a few bad apples ruined it for everyone, the version where it could never happen again because we've learned our lesson. Because if we learned anything from 1929, it should be this. The people who are most confident that they've learned the lessons of history are usually the ones who are about to repeat it. The real tragedy of the Great Depression was not that it happened, it's that it didn't have to. The tools to prevent it, or at least to contain it, existed. The knowledge, or at least the beginning of the knowledge, was available, but the people in power, constrained by outdated thinking, institutional inertia, and their own inability to imagine the unimaginable, failed to act in time. And millions of ordinary people paid the price. So the next time you hear someone casually reference the crash of 1929 as a simple cautionary tale about what happens when people get too greedy, remember that the real story is far more complicated, far more damning, and far more relevant than that. The crash didn't destroy the American economy. The response to the crash did. And the question we should be asking ourselves is not whether it could happen again, but whether, when the next crisis comes, we'll have the wisdom, the institutional courage, and the political will to respond differently. History suggests we shouldn't be too optimistic. If you found this deep dive illuminating, I'd really appreciate it if you'd subscribe to the channel and give this video a like. Every subscriber helps us reach more people with the kinds of stories that don't get told in the mainstream. If you made it all the way to the end, drop a $sign in the comments. I'd love to see how many of you stuck around. Thanks so much for watching, and I'll see you soon.